Hello everyone, I hope you're well. This is the video lecture for Chapter 5 related to audit evidence and documentation. So, the key here is we've established the environment in which the auditor is going to be operating in through the previous 4 chapters. And now we're going to move into this section that's kind of a high level view, or maybe not high level, but a generic view of how to do the actual audit. And then after we've had a chance to master some of this material, then we'll get into the different transaction cycles and think about how to apply this audit methodology to a particular transaction cycle, like the revenue cycle. But for now, we're going to focus on big picture. Let's think about what an audit entails, and so we're going to talk about audit evidence today. There's a lot of learning objectives here in this chapter. These chapters are going to start getting a little bit thicker, and a lot more content in them than some of our other chapters. So I'm going to try and stick to the high and the medium learning objectives for the most part. Maybe briefly touch on the low, but for the most part, trying to hit the high and the mediums in terms of priorities. So the first learning objective is explain the relationship between audit risk, audit evidence, and assertions. Okay, and so let's define these and then see how they relate. So audit risk, basically it's the risk that we're going to get the audit wrong. Remember, the main thing that's communicated in a financial statement audit is an opinion. And so our main risk is we're going to get that opinion wrong. And even though technically there's a couple different ways you can get it wrong, we typically focus on when we say everything looks fine, right? That's the unqualified opinion. But then the reality is that there's actually a material misstatement. So that's usually the risk that we're focused on as auditors. That's the risk that we plan our audit around for the most part. Now, in order to make sure that, or to mitigate that risk, the risk that we got the audit wrong, the conclusion wrong, the opinion wrong, we need to obtain enough evidence to make sure that we feel confident in our conclusion, right? So audit risk is the probability we're going to get the conclusion wrong, and so we need to make sure we get enough evidence to feel comfortable in making the right conclusion. So we have some assertions here, and some of these are combined a little bit. The PCAOB talks about assertions. The international standard setters talk about assertions. The statements of auditing standards talks about assertions. I'm not going to worry as much about what each one says as much as I'm going to try and combine them here into a set that we can process. So the first one, and again, what is it? Let me step back. What is an assertion? This is a claim made by managers about the financial statements, okay, and about the process to create the financial statements. And so the first claim they're making is related to existence or occurrence, okay? So they're technically different, but let me just lay out for you the differences. So existence is that our assets, liabilities, and equity actually exist, right? They're valid, they're real things. They're not made up assets, it's not made up equity, right? Those things exist. Occurrences is that the related transactions have actually occurred. So we're going to treat them as one, even though technically they're slightly different, but it's essentially transactions have occurred, and because those transactions have occurred, we know that the assets, liabilities, and equity actually exist, right? So those are valid. The next assertion is rights and obligations. So the company holds rights to these assets, to the assets they're claiming. So if they're listing fixed assets with a building for a certain amount, then okay, do they actually own the rights to that building? And then on the flip side, liabilities that are listed are actually obligations, right, of the company. Most of the time, you're not going to have companies trying to claim too many liabilities, but there may be situations where they actually could have an incentive to do so. But rights and obligations are just that the assets and liabilities that are listed on the balance sheet, the company actually has the rights to those assets, and actually those are obligations of the company. Completeness is another assertion, and so this is that all the transactions have been recorded um, that should have been recorded. So existence and completeness tend to get confused at times, but completeness is that if we start with a set, or if we start with what was recorded, um, is it full? Is it a complete set of transactions that are listed there, or have some transactions been left off, right? Whereas the existence is the opposite. It says um, have if you have a set of transactions, are all of those valid? Are any of them in there that don't belong? So even though they're related to this idea of what's recorded versus what is in reality, they have they're different spins on them, and we'll kind of work through that as we go and apply it in different contexts. The next assertion is cutoff. This is basically just that transactions have been recorded in the correct period. Excuse me. And so, for example, if you have a 12/31 year end, well, you shouldn't have any transactions that are for the next year. And similarly, if the cutoff is 1/1, January 1st, then you shouldn't have any transactions from the prior year also in the current accounting period. So cutoffs are important. Um, the next assertion, or kind of grouping of assertions, is what I'll lump together as valuation, allocation, and accuracy. This is basically that all the transactions are listed in the right amounts, right? So you're not making any errors when you put in a purchase order, or when that's the accuracy. You're not using the wrong method for your inventory allocation, right, where you're putting amounts to cost of goods sold, or you're not listing your financial instruments at the wrong valuation amount, right? So those are kind of related in that they're related to the correct amounts. And then lastly, for our purposes, will be presentation and disclosure. And here, the accounts basically that are listed on the financial statements are complete, appropriate, and appropriately described on the financial statements, right? So this is where you could get into things like, do you have the proper footnotes? So if you have a footnote on leases, is the footnote prepared and described the way it is supposed to be based on GAAP? Okay, so next is thinking about the components of audit risk. We've talked a little bit about audit risk, defined it. Now let's think about what makes up the risk that we're going to get the opinion wrong. Okay, and so it's a little bit of a busy slide, but ultimately the audit risk is the risk that there is a material misstatement times the risk that we as auditors fail to detect it. Okay, so we can break out that risk that there is a material misstatement present in the financial statements before the auditors do their work into two parts. One is inherent risk, which is just based on the nature of the company, how young it is, for example. Is it growing? All these things. Is there just an inherent risk with this company? And then the next piece is control risk. So it's basically the company's internal control system, which you learned about in the AIS class, or are learning about in the AIS class for a few of you. And that's the risk that the company's internal control won't prevent or detect it in a timely way, like prior to the auditors getting in. And so those two pieces make up the risk of material misstatement, and then the auditor's piece is detection risk. That's the risk that we're not going to catch a material misstatement. and it's going to make it through to the published financial statements. Okay, because the reality is the company itself, right? There's a whole set of there's risks there as far as their innate characteristics, right? Things that are not easily changed. And there's risks related to the internal control structure they place on their operations. And then there's the detection risk of the auditors. And all three of those go into the risk that the financial statements will have a material misstatement and the auditor's opinion will not reflect that. There's different ways to kind of think about this. One way around is this graphic uses sand as an analogy, right? That's the inherent risk. And then you have these colanders or sifters or filters or whatever. And so can the internal controls of the firm catch the problem before it makes it to the auditors? And any those two together is kind of the risk that there's a material misstatement prior to the auditors doing any work. And the detection risk is the risk that the misstatement will not be detected and make it through the auditor's procedures. Yeah, so you'll see me sometimes write this out in this way: audit risk equals inherent risk times control risk times detection risk. And we'll do a little bit more with this later as we go along. All right, so what are some factors that affect inherent risk? The nature of the client, its environment, the nature of also a particular financial statement element, right? So things around the client would be, let's say you have a client that's just struggling to be profitable. It could be because they're early on in their life cycle, or it could be because they're late in their life cycle. But that would suggest there's a risk that the managers might materially misstate the financial statements. If the firm's operations are highly cyclical, right? That's what it means to be highly sensitive to economic factors. So if the macroeconomy impacts the results of the firm greatly, then that would be something we'd want to look at to see if there's a heightened risk for this financial statement period. If you're worried about the firm continuing on as a going concern, perhaps it has a very high debt-to-equity ratio. Perhaps it's very highly levered, and so you're worried about them being able to continue on. And if you've had misstatements in prior audits, right, then that's a heightened risk for the company. Also, if there's a lot of turnover, say you have a lot of turnover in the key financial reporting roles, there's that would then suggest there's a higher likelihood of errors as opposed to fraud. But still, whether the material misstatement is from error or from fraud, we need to be able to design our test for both of those. Okay, so then how does inherent risk map into the assertions about the financial statements? How does it map into the auditing? And so if we have high inherent risk, then some examples of, you might have transactions or balances that are just difficult to audit. It's hard to, for example, to collect the evidence. The evidence isn't very super reliable. Maybe thinking about some manager estimates, right? And so that's how it could flow into a material misstatement. It could be there's some complex calculations where, for example, you have some complex financial instrument, right? And you're trying to apply all the rules related to the financial instruments. And I'm thinking of things like derivatives and hedges and those kinds of things. So those could be complex. And just having difficult transactions, difficult methods, difficult calculations. If there's a lot of judgment required by managers, these are all ways in which you would see the inherent risk kind of being played out in creating more risk that the auditors are getting it wrong. Another potential characteristic here that can be related to inherent risk is this idea of routine versus non-routine transactions. Um, Things that are happening every day, like sales orders and purchase orders and invoices coming in, invoices being sent to customers. Those tend to have a little bit lower inherent risk just because, one, there's usually a lower dollar amount for those, but also hopefully the internal controls are set up in a way that helps with that. Although we'll get to the control risk later. But just the idea, just thinking about from an error perspective, if you're doing things every day, hopefully you're going to get good at them, right? And hopefully the company's going to get good at them, and so there'll be less risk because they're used to doing those activities. Whereas the non-routine, those are things where you're not going to have as much um, frequency of the transaction, and so you're more likely to have errors come in and possibly manipulation come in if these things aren't done routinely. And so this routine versus non-routine can kind of also be an indicator for how high the inherent risk is for a given financial statement account. And then last is thinking about estimation transactions. I mentioned that a couple times already. So just the fact that you have to have estimates means that there is some subjectivity there. There's some room for manipulation, and so those pose a higher risk, inherent risk. So now let's layer in this idea of audit evidence, and so let's think about sufficient and appropriate audit evidence for this learning objective. And so you have to have sufficient evidence, and it needs to be appropriate, right? It needs to be relevant, timely, those kinds of things, and reliable. And so relevant just means it relates to the particular item you're auditing. So if you're auditing cost of goods sold, then that means we probably need to see things like purchase orders for when the inventory comes in. If you're a manufacturing company, then you need to see kind of the work in process records and how goods are being placed into work in process, and then how they're eventually being moved to finished goods, and then how the costs are being allocated to finished goods. And then reliable means that we can trust it, right? So there will be some evidence that is created internally, right? Thinking about the work in process, for example, there's no outside evidence we can look to see, how many how much raw materials was put into the production process this period. But that's definitely a lower level of reliability compared to like a vendor invoice, right? Or a vendor statement that shows how much our client owes their vendor. And so we need both of those, relevance and reliability. And sometimes we just have to settle for whatever the level of reliability is. But again, those are the two that kind of help us think about, is this good evidence or not? And is there better evidence out there? And so, like I mentioned before, if we have an outside source, then it usually is considered more reliable. If it is internally generated evidence, then if you have a good system of effective controls, then you're going to have more reliability on that evidence than if it's an ineffective system. And if you can obtain information as the auditor instead of through the company, then that's usually better as well. So we'll talk about some examples of that as we go, where the auditors are the ones that might be requesting information from an outside party. And obviously, it's better to get evidence that is documented rather than just told to you by managers. You'd always prefer that to be documented, and it's always better to get originals. Granted, this was back in the day when a lot of evidence was paper based. We're kind of moving past that, but to the extent that you can have some comfort around the originality of the evidence, then you're going to feel more comfortable with it.